Whenever we talk about investing in growth ETFs, the number one ETF that always comes to mind is the QQQ. With its incredible growth over the past decade, the QQQ has rightfully earned the title of the best performing large cap growth fund over the past 15 years. But what if I told you that QQQ as well as the QQQM are not the best growth ETFs to go for? What? Yes, you heard that right. The best growth ETF to invest is not the QQQ, but rather the Sharp US Large Cap Growth ETF with the ticker symbol SCHG. So, in this video, I'll be explaining why you shouldn't be investing in QQQ or even all of the other growth ETFs, but instead, you should go for SCHG. But before I start, do join my 9,000 members Telegram chat group to discuss or ask any questions that you may have. In order to understand why SCHG is the better ETF to go for, we need to first understand how QQQ became the best growth ETF. And it all has to do with its holdings. As you may know, the QQQ ETF tracks the Nasdaq 100 index, which holds the 100 largest non-financial companies listed on the Nasdaq exchange, which, as it turns out, a little more than half of the holdings are in the tech sector. So you have companies like Apple, Microsoft, Nvidia, Amazon, and so on. But how did QQQ manage to achieve such great returns over the past decade? So what happened was back in the late 1990s to the early 2000s, right around the dot-com bubble era, the internet revolution began. This gave rise to many of the tech products that we still use today, like the Apple iPhone, Facebook, YouTube, Amazon Web Hosting, Google Search, and many more. Then, when the stock market started recovering from the great financial crisis, tech companies started taking off and gave a whopping 21% annualized returns from 2009 till now. This of course greatly benefited QQQ, which had a large part of its holdings in tech. But check this out. Here, we have 4 of the top growth ETFs, namely QQQ or QQQM, SCHG, VUG, and SPYG. What's interesting is that even though VUG had a much larger allocation in tech, its 3-year, 5-year, and 10-year annualized returns had underperformed QQQ. Likewise for SPYG, which despite having almost the same percentage of holdings in tech as QQQ, it still came in last in terms of its performance. But what about SCHG? Interestingly, even though it has the most number of holdings on its list and having the lowest allocation to tech, it still managed to come in second place for its 5-year and 10-year annualized performance. Not only that, it has even outperformed every other ETFs on this list for the 1-year and 3-year periods. So, what's going on? The answer lies in how each index selects their holdings. First up, for the QQQ, which tracks the Nasdaq 100 index, the selection process is pretty simple, whereby they just rank eligible companies based on market capitalization with a few extra rules added in to prevent over-concentration as well as to cover any edge cases that may happen. Whereas for the rest of the ETFs, the rules are a little more complex. For example, for the index tracked by SCHG, it selects holdings based on criteria such as the projected price to earnings ratio, projected earnings growth, price to book value, as well as the dividend yield, trailing revenue growth, and trailing earnings growth. This is the same for the index tracked by VUG, which selects holdings based on the book to price ratio, future earnings to price ratio, historical earnings to price ratio, and so on. Likewise, for the index tracked by SPYG, which also selects holdings based on their own growth criteria. Quick pause. In celebration of Singapore's 59th birthday, Poems by Phillip Capital is currently running a welcome promo, where you can get up to 1,500 SGD worth of rewards. To qualify, you can sign up with my link down below and make sure that both Smart Park and CFD are ticked during the sign-up process. And upon account opening, you receive an exclusive People of Phillip NFT alongside with other goodies such as 0 US commission for 90 days, free live prices for SGX markets, US market, and US options, as well as free SGX enhanced market depth access. Then, depending on how much you fund and trade, you get to earn additional sign-up gifts. For example, in Tier 2, if you make an initial deposit of at least 10,000 SGD within 14 days of account opening, keep the funds there for 30 days while making 5 buy trades of stocks, ETFs, or unit trusts within 90 days, you get 2 fractional shares worth $60 each, plus 3 fractional shares worth $20 each from the previous tier. Then, if you are the first 1,000 clients who sign up, make an initial deposit of at least 20,000 SGD and keep the money there for 30 days, You will also receive a 5.9% per annum guaranteed returns for 30 days, capped at $100,000. This deal is only valid till 31st August. So if you are interested, you can chop sign up with my link down below. And with that being said, let's get back to the video. Now, obviously, it's hard to tell which index has the best selection criteria if we just look at them like that. But what we can be certain of is that the way QQQ selects its holding is super straightforward and possibly to the point that it's even too naive. And as a result, while it has managed to produce the highest returns out of all the ETFs here, the QQQ comes with three major drawbacks. First, with just 100 holdings, or in this case, 101 holdings, the QQQ is rather concentrated, especially when compared to the rest of the ETFs here. They have at least 188 holdings or more. Now, of course, this is a good thing when times are good, like right now, where the market only seems to go to the moon. But when times are bad, it can crash super hard too. But I can already tell what you are thinking.
But investing horizon is long. Market crashes are irrelevant to me. In fact, I like market crashes since I get to buy the dip while cry and deter, of course.
Okay, but here's the second downside, and that is the QQQ only holds stocks listed on the Nasdaq index, whereas the other three ETFs hold stocks listed on most, if not all, of the US stock exchanges. And as a result, the QQQ may miss out on certain good stocks that are not listed on the Nasdaq exchange. For example, it doesn't have Visa, which is listed on the New York Stock Exchange. This company saw some incredible growth in the past, and with its strong moat and strong growth opportunities, is likely able to continue its strong growth in the future. Another example is Eli Lilly & Co., a pharmaceutical company that is also listed on the New York Stock Exchange. It has also seen tremendous growth in the past, and by leveraging on artificial intelligence, they might just find their next breakthrough. Now again, I know what you may be thinking.
Who cares about these companies? The strongest companies are the tech companies. And with the AI revolution, tech companies will continue to dominate in the future.
Well, maybe that is true or maybe not. No one knows. But what we do know is that AI will benefit many other sectors like banking, capital markets, energy, communications and media, health, and so on. So while tech has performed very well in the past, they are not guaranteed to continue outperforming in the future. For example, a study found that stocks tend to give the highest return before they reach the top 10. And once they reach the top, their returns start to slow down. This may come true for tech stocks, which may start to underperform and may eventually be overtaken by some other companies which experience breakthroughs. For example, perhaps it could come from companies from the healthcare sector when neural implants finally become viable, or when gene therapy goes mainstream, or maybe the finance sector when crypto finally becomes a mainstream payment method. This is similar to back in the 1980s, where industrial companies were dominating the top holdings but were slowly replaced by tech companies as time goes by. And that's when QQQ will miss out, because it not only limits itself to the Nasdaq index but also has very little weightage in healthcare while skipping out on financial companies altogether. And guess what? We do not even have to wait too long to see the effect of this playing out, because this is already starting to affect QQQ. That's because while tech companies, especially the Magnificent 7 stocks, have done very well over the past 1 to 2 years and largely contributed to the S&P 500's return, given that the Fed is about to lower rates soon, many other non-tech companies are now starting to play catch-up. This is also known as the market broadening. As a result, every other sector has been outperforming the technology sector over the past 1 month, which has led to every other growth ETFs outperforming the QQQ. Which brings us to the next question. So, why go for SCHG and not the other two growth ETFs? Few reasons. One, to simply put, due to how SCHG selects its holdings, SCHG has a better historical performance as compared to the other two ETFs. And if we further drill down to the individual years via the portfolio visualizer tool, SCHG, the blue bar here, has outperformed the other two ETFs in most years. This is despite having almost similar drawdowns whenever there's a market crash. Second reason, given that SCHG has the highest number of holdings, it is a little more diversified as compared to the other ETFs. This allows it to further reduce its concentration risk while at the same time being able to tap on more opportunities for growth. For example, even though SCHG has the lowest weightage to technology stocks as compared to the other ETFs, it has still managed to give the highest return for the 1 year and 3 year periods. And due to its slightly lower weightage to tech, it is also less susceptible to headwinds in the tech sector, such as antitrust laws and broad-based regulation. Not only that, SCHG has also a slightly more even distribution to the next 4 sectors, aka communication services, consumer discretionary, healthcare, and financials as compared to the other 2 ETFs. This could also benefit it as it's able to better react to a fast-changing environment in the future. Now, don't get me wrong, I'm not saying that the rest of the ETFs are bad because all of them are pretty good ETFs and you won't go wrong no matter which one you choose. Because first, they let you passively invest in the best growth stocks in the US and possibly the world without doing much work. They are all self-cleansing, aka they will automatically kick out bad stocks while keeping the good stocks. And the ETFs are all passively managed, which means you get to enjoy a much lower expense ratio, though QQM has a slightly higher expense ratio of 0.15%, while the rest of them have a much lower expense ratio of just 0.04%. But due to how SCHG chooses its holdings, it has not only managed to give the second best long-term return, but also started outperforming all of the other 3 ETFs in the short term. And if this continues, I wouldn't be surprised that SCHG will eventually emerge as the best growth ETF in the future. But do let me know what you think. Will you be going for SCHG or would you still prefer to stick to QQQ? Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.